We've got three wonderful folks who are going to be talking for 10 minutes each. They're going to be kind of demonstrating and showing an area of the world to you that we need help, we need support, we need investment, we need people rushing in and doing things. You're going to be able to ask questions after that, rapid fire. So as you're seeing and thinking about these, love for you all to have your brains very turned on for what are the kinds of things right after that presentation that you'd want to know, that you'd want to press on and consider. At the end of that, all three will then sit up here and have a conversation with KD. Does everybody know KD?
I'll introduce myself.
Well, so in Connecticut, we're like the one-call state, right? Like you can always find the person you need within one call. And Constantine is the person who's that one call at Connecticut Innovations if you're thinking about climate tech innovation. So runs the Climate Tech Innovation Fund. He's a YSE or FES alum when he graduated. Kind of deeply connected into this entire ecosystem and really thinking about building up both climate tech as an industry and economic development and growth in the state of Connecticut. So Constantine will be your host for this, and we'll introduce all of our panelists. Thank you for being here. Have a good time.
How's everybody doing? Good? All right. Good to see you all. Thanks, Stu, for the introduction. Thanks to Yale for hosting this event and for doing the reverse pitch. As Stu mentioned, my name is Constantine Drakonikis. I am the Managing Director of Connecticut Innovations Climate Tech Fund. I did graduate from here. I don't know how, but I made it through back in 2006. So this year is my 20th anniversary, which is insane. Thank you. And it all started for me, and this is a little bit about my reverse pitch. It all started for me basically at Yale. I got into venture, I got into entrepreneurship when I was here. So I did the street joint degree version of the MBA, MEM. Which means I took a lot of MBA classes, but I was here at FES and YSE. And I took a class that was based on venture capital, business entrepreneurship. Prior to that, I was a practicing civil environmental engineer. I have a degree in environmental and chemical engineering. I practiced for a number of years, basically trying to learn the way our industrial systems work so that I could then have an impact. My family was all in medicine. And I was the only one who didn't do that. And I was like, well, maybe I can kind of be like an engineer physician for the environment. I can help make an impact. And I can help, bring new technologies and innovation and achieve some sustainability. That got boring pretty quickly for me, and hence my sort of journey into Yale here. But while I was here at Yale, I was part of that program of entrepreneurship. It was a year-long program. And it was sort of the early days for a lot of the graduate student-based entrepreneurship programs that have now bloomed here. And I was part of a group that started a little company called The Good Fish. And this all kind of stemmed from, global fisheries crashing and sort of trying to find that solution. And we went out there and we found some interesting technology, novel, innovative land-based aquaculture, where we then incorporated the principles of industrial ecology and symbiosis, where we were leveraging waste streams of heat and water to try to make a very cost-effective fish farm. And we were about to launch it with a partner here in New Haven, PSEG, but we didn't really do our sort of global market diligence. And we didn't really realize that there was a lot of really cheap, good tilapia and shrimp that was going to be coming right into the U.S. market out of the Asian Pacific. And so after we did our business plan pitch and we won the Y50K, I don't know if you guys remember that, we incorporated, we were going to start going out there and executing on air permits and all this great stuff. And then all of a sudden the price of tilapia dropped. And we were like, shit, we should have saw that coming. So all the customers that we did our diligence with, the grocery chains, et cetera, they were like, yeah, we're not really interested in organic and sustainably raised fish anymore. Thanks, but we'll see you later. So that was my first lesson in how to fail fast and how to be an entrepreneur and take that lesson and move on and maybe try to find the next big thing to do. So after Yale, I went on and I got into environmental finance with the Connecticut Green Bank. And then I joined a family office and I helped start a venture firm called Launch Capital. And while at first I was doing clean tech, very quickly became a generalist and I started doing med tech and deep tech and frontier tech. And then in the last 5 years, I've come back and I've said, I want to do climate again. And so we stood up a $100 million fund at Connecticut Innovations. We aptly named it the Climate Tech Fund. And what we do is we partner with institutions on the very early side of the equation. We help companies incubate. We help spin them out of universities or wherever they're coming from. We help them find a home with our partners like Climate Haven, where they can actually accelerate their growth, find other investors. We write really early checks, 100K, 150K, and then we are a partner with them across their journey into their growth if they make it there, where we can then write bigger checks. We can leverage our venture debt fund, and we are truly a very patient climate tech investor, very much with sort of a backbone in deep tech. What allows us to do that is we're an evergreen fund. So, and that's not an old thing, but it's a new thing too. There's different nonprofit fund models. There are longer fund models now on the venture side that allow for companies that have a longer life cycle to achieve the ultimate goal, right, which is commercial success and penetration. So that's a little bit about what we do. We do have a Connecticut sort of driver here, as Stu mentioned, which is we want you to do as much as you can here in the state of Connecticut. We want you to hire as many people as you can in the state of Connecticut. And that's our job, and we help you do that through internal HR and recruiting. We try to make it as simple as possible to partner with us. And you know me now as a partner at the fund. Sort of my background. I'm not just an investor, I'm an entrepreneur. I've actually started a few other companies along the way. And I think that's important for entrepreneurs and founders to know who they're investing with, who they're partnering with, who they're actually getting married to. Because it is kind of a marriage, right? It's a partnership. So with that, you're today going to hear from three lovely people who are going to bare their souls. They're going to tell you what they're about, why they're doing venture capital, why they want to invest in the sectors that they're investing in. They're going to identify some of the problems within their investment thesis, both that their firm is experiencing, but also maybe what their portfolio is experiencing. And then, they're honestly looking for feedback. They want to be better at what they do, and they want to be a better partner. So with that, I'm going to call up, who's going first? Eric? Eric, I'm going to have each of you guys introduce yourselves, and then we'll do a little bit of banter back and forth with questions. Then we'll go down the line. I think, Noah, you're after that, and then Adriana's bringing it home, or not, actually maybe going out. And then we'll bring it together, as Sue mentioned, and we're going to have very open, organic conversation with all these folks. So thank you very much. Let's welcome Eric.
All right, thank you, Constantine. So I'm going to follow Constantine's lead and give a little more of an introduction than I was going to, because this is kind of a full circle moment for me. I was a Yale undergrad, 2004. And similar to Constantine, my dad's a doctor. I thought I was going into medicine, came in expecting to be pre-med. And so energy wasn't on my mind at the time. But what developed while I was at Yale is I met a couple folks who were presidents of energy trading companies. And that led me down a path because they made a comment to me at a dinner, I think my sophomore year. That was, why aren't students going into energy trading? And my response was, what is energy trading? Maybe it's because we don't know what energy trading is, why we're not going into energy trading. Because people were, if they were going into business, they were going into investment banking, consulting. And that kind of stuck with me, where I wasn't actively thinking of going into energy trading at first, but I started actively thinking of not going into medicine. And that kind of led down a path into business, which quickly led into energy trading. So the power problem that I'm about to describe is one that I've been exposed to for a while now, actually, back at my undergrad, just a mile or so down the block. So let's get started. So what was dubbed the energy transition, in the way that I'm looking at the world now, has morphed into this industrial revolution that is the newest version of the industrial revolutions that we've had. Technology is driving efficiency gains, new synthesis pathways, and breakthroughs in power generation. And the future is one where new technologies are going to change the impact of how we live without changing the way we live. At least that's the vision that I have in the near term of the way the world is going to continue to evolve. So it's going to increase our quality of life while also hopefully decreasing the cost of living. I started a venture fund about 5 years ago called New Climate Ventures, colloquially known as NCV. We are Houston-based. We're an early-stage venture fund investing in private companies that are building the future of how we produce, power, and consume. That makes for a reasonably broad mandate, but it's kind of a narrow lane as well, because we are looking for technologies that are going to be transformative, but can also come to market quickly, that ideally come to market quickly, that can reduce this cost of living. But in order to do that, you need to scale the technology. So you need revenues early. You need to really anchor all of that in an actual business model that is going to be revenue generating and scalable in an earlier period of time. And when people look at these technologies, a lot of people just assume that they're very capital intensive. And while they are capital intensive, because a lot of them are hard tech, they aren't necessarily capital intensive for the companies themselves. It could be others, thus industry, that is helping to finance that because it's a need of the world. We actually need these things in order to operate. What we found while we were investing out of our first fund is that 80% of our first portfolio addresses this new industrial revolution theme, and 50% of it actually addresses an AI data center picks and shovels thesis at this point. And that's kind of a new evolution over the past year and a half. Some of that has to do with how you define the picks and shovels, which we'll get into in a second, but a lot of it is revolving around power, whether that's the production of power, the transport of power, or the reduction of power need, because you can create efficiencies and reduce the actual energy need of buildings and use cooling technologies in order to reduce energy need as well. So these successes, the way that we're viewing it from Fund 1, are informing our approach to our upcoming Fund 2, where we're leaning into this idea of platform technologies, cost competitive technologies, beachhead markets. So in the case I'm about to talk about, data centers as a beachhead market, because that's how it's kind of evolved for some of these companies, where their beachheads they were going after weren't the actual anchor customers in the end when they started manufacturing last year. Revenue traction being early and unique deal flow is another thing that we just find to be very important. Collaborating with people in this room. Constantine and I just co-invested in a company, for instance. And that kind of collaborative effort is something that's very helpful for the entire community of VCs, whether you're a CVC, a sovereign VC, or a financial VC. And it really reminds me of these physical trading days back when I was physical trading, because there you had to be collaborative as well. If you didn't have access to the commodities you needed when you needed them, say there's a hurricane and it knocks out production and you were supposed to get your commodity off of that production, you need to be able to call someone and backfill that without getting totally disrupted or priced out. Trying to use a kind word here, but you need that help. You need someone that's going to help you because they know that you're there to help them in the future. And in the VC space, it has to be very collaborative, particularly in these early stages. So the problem is that we've returned to power demand growth. We went through 15, nearly 20 years where there was zero to negative demand growth in power. What that led to is underinvestment in power infrastructure. And what's happened in the last few years is you've actually seen a return to power demand growth. What's interesting is, yes, data centers take up a lot of the breadth in the room. There is a lot of CapEx going toward data center development, and it is a rapidly growing area for power demand. And there's a lot of capital going toward it, but also a lot of that capital is going to build the infrastructure that we need in order to actually improve our grid. What's more interesting is data centers are the fifth largest growth center for power demand, as it's forecasted by the International Energy Agency and many others, over just the next number of years. The news would lead you to believe that data centers are the only thing driving demand growth. But mobility so electric transport is the number 2 growth center. Industry is the number 1 growth center. Appliances are number 3, and space cooling number 4. And if you put space and water heating into that space cooling segment, you're talking about massive demand from power or for power from these areas, even ahead of data centers. So what's interesting is data centers are financing a lot of this build out of infrastructure, but they aren't necessarily the only driver, and they're not even the biggest driver of what is this demand growth. So what do we need? We need data centers to come on quickly because we need this AI in order to change the world and improve the way that we all live. But the number one limitation that data centers have is the power demand and needs, and that's the limiting factor for them actually coming online. So where we have this production growth, this demand growth happening, it's just not happening fast enough in order to keep up with the demand. So when you see things around cancellations of data centers or delays, some of that, yes, is due to financing not being able to be lined up. That's another factor. But the number one is if you can't get the power online on time, then you're not going to be able to bring the data center online on time, period. It's full stop. So data centers, what have they started doing? They started building their own power plants. They're going behind the meter. 30% of data centers now are going behind the meter. I would anticipate that in my limited knowledge of what data centers are actually doing, but in my belief that we can't build out the power infrastructure fast enough for data centers, let alone the needs of the grid, that they're going to continue to be building behind the meter to the extent that they can get the actual power online on time. So the other thing that data centers need is to be able to operate continuously. So 1 gigawatt data center creates about $1 million a day in revenue. So every day that you're not online, whether it's due to delays in being built out or if it's in disruption, is $1 billion of revenue lost. Now you're starting to see articles coming out even recently about data centers that are getting shut down due to overheating. You're seeing it due to power disruptions. We're going to continue to see these kind of issues just because they are the issues of keeping things online. When you have events that you can't control, like natural events, hurricane, an earthquake, flooding event, all these things are going to knock things offline, particularly when you're building a lot of these things in Texas and you're building a lot of these things in Virginia, where you just had a hurricane come through North Carolina a couple years ago. So all these things are additive to the interest in there being redundancy in power supply, and there being just a lot of availability or reduced power need in order to kind of mitigate some of these risks. So the way that we're thinking about it is that you have building materials and critical minerals that go into the manufacturing, whether it's of chips or the buildings. You have generation and storage, of course, and you're going to need a multitude of different solutions there. So whether it's geothermal and nuclear being a more distant option, geothermal being something that can happen very soon now with even the IPO of Fervo which was a couple of weeks ago, which is a leader in advanced geothermal technology, kind of starting to pave the way of the speed that geothermal is going to come into this power mix. But we already are well aware of the cost reduction that's come from solar and the integration of solar and then batteries now as well. I think I'll show a slide on that in just a minute. But you can also reduce your energy need through operations, whether that's through software that is helping to actually give guidance toward how to operate on a day-to-day basis, or can actually automate and reduce the energy need by optimizing entire data centers. You can create cooling liquids from a lot of different sources, one of which we're invested in turns carbon dioxide into a data center cooling fluid, which is new and novel and just starting to scale here over the next couple of years in terms of production. And in cooling towers as well, we have a company that can take oxygen latently from the air. You put water in their system, it combines the two into hydrogen peroxide, and that hydrogen peroxide is being tested in cooling towers to be able to clean the water, which then keeps things cooler longer, keeps the cooling towers operating without needing maintenance longer, reduces cost, all things that can be helpful to the data centers. And then, of course, there's the grid and transmission. So we're investing in an automated grid simulation company, for instance, that can actually help companies, instead of it taking 2 to 6 months to do the analysis around the grid connectivity and how much power they're going to need and how that's all going to work with permitting and within regulations and whatever area they're in. It can do all that analysis within a couple weeks. And we introduced them to a customer in Houston that before we even invested in the company, that became a customer before we invested in the company, and that gave us a lot of confidence that their solution was one that was going to be working for a broader community of power developers and others, data center developers as well. But you also have new conductivity of distributed compute. You have smart transformers now. You have all these different things that are just on the cusp of scaling that can really transform the way data centers operate as possibly a beachhead, but also have a lot of aperture into other industries.
I think wrap it up.
And we'll wrap it up here, for questions in a second. So, costs have come down. When costs come down, it's part of the scaling. So you see the scaling happening in solar and wind and batteries, and you're going to see that in all these other things. And really that aperture is there across a number of different types of companies, a couple of which I just pointed to. So we'll wrap up there.
Awesome. Thank you. So I'm just going to throw out a few questions, and then we're going to move next to Noah. So, one of the things in my experience with great tech companies is that you run up against this problem. I can't quite figure out a nice way to say it. The partnership required with utilities, because ultimately they control the grid, both on the regulated and the unregulated side.
Yeah.
Is there a model that works to help with your startups or the startups that are sort of, within this ecosystem, gaining that adoption with either, more progressive utilities or not, maybe more on the distribution or the generation side? What are you kind of seeing in the market today that can really help some of these startups? They're trying to disrupt this. They're trying to actually help build more sort of resilience and robustness into the grid. Is there anything you're seeing there, a model that works, or any of your portfolio companies sort of cracking that nut?
I'm working out how to make utilities work faster to integrate things. Is that basically what we're talking about? I think it's just having people that have actually been in industry that are in these conversations. So the startups, if you're a founder who's never actually worked with the utility and trying to work with the utility, that's just more challenging because there's a learning curve, right? So, being able to speak their language is helpful. But the problem is it just takes time, even when you have worked with utilities and you have that knowledge. So, that's where the behind the meter really, I think, is the differentiator for where we're going to be over the next few years. Is if you're not behind the meter, you can't bring things online fast enough. So you need to be building those, not just the relationships, but working with those utilities years in advance in order to bring that connectivity on and get all the permitting and everything in the right place. But you could bring on something behind the meter without having to worry about that. You're seeing everything from hundreds of diesel generators powering data centers, and I'll just use data centers as the example still. But you're seeing hundreds of diesel generators. You're seeing gas-fired power plants. You're seeing all these things. But some of the announcements have been that you're bringing the gas-fired power plant online 2 years ahead of when it's going to connect to the grid. And that's, I think, why that 30% number is just going to keep increasing, because I don't know how you manage this in an integrated fashion into the grid fast enough. So it's a question of speed, ultimately.
And that's definitely on the generation side. But what about some of the new superconducting, critical, technologies that are more on the distribution side? I think
that's an area I'm less familiar with, so I'm going to have to defer to
I think
others.
we're all trying to figure that out.
Yeah, because I mean, and also for background, like I came from the oil side, so my years trading were oil, refined products, natural gas liquids, petrochemicals, plastics. So, I peripherally knew what was going on the power side, and a lot of it's just back then, at least, was you had gas production growth that brought gas prices down to such a point where all of a sudden that was the kind of industrial revolution happening then with fracking. And then you had solar and wind really taking off. And so, on the distribution side, I'm just less familiar.
Gotcha. All right. Thank you, Eric.
Yeah.
All right. Morning, everyone. My name is Noah Lerner. I'm a vice president with Springline Capital, and as a Yale, YSE, and SOM alumni, it's an honor to be back here with you all this morning. So the topic I want to talk with you all today is about what we call the missing middle of emerging climate infrastructure. Talk a little bit about how we see this problem, how the Springline, the firm I work with, looks to invest in this space. And then just as, I think data centers, we all acknowledge, are transforming the energy system today, want to talk a little bit about what we see autonomous vehicles, looking, likely to disrupt sort of the transportation infrastructure systems over the next coming years, and how we're thinking about that as an investment asset class. So first, just a little bit on Springline Capital. So we are actually not a venture fund, so apologies for those who are just coming to hear VCs talk. We're sort of a real assets growth investor that sits in between venture capital and kind of larger mainstream infrastructure. Really, our firm was built around this mission of how we help deploy emerging infrastructure assets to unlock the sort of larger institutional capital and create new markets. And we do that by partnering with developers to de-risk execution and provide fit-for-purpose capital. So what is the missing middle? I imagine a lot of you guys have seen various charts like this. This is sort of showing the progression of technology. TRL is technology readiness level. And really the way we think about it is, at the sort of commercial stage where companies are really requiring kind of larger scales of capital to fund deployment, but not yet where these solutions have the kind of longer track record that is needed often to attract sort of the lower cost mainstream infrastructure capital. This sort of project finance valley of death, what we call the sort of missing middle, is exactly where my firm sits. And I'd say it's a challenge for kind of a large part of the climate tech ecosystem that has sort of very capital intensive business models. Sort of the software ecosystem, I'd say, has its own different challenges. But, I think one question is sort of, there are firms in the climate tech space that are bringing new technology to market where they have been successful in raising sort of the large, $100 million, $1 billion venture rounds to fund early deployment, which is impressive and very difficult to do. It also creates a very narrow operating window where you have to sort of execute perfectly on time with a very large sort of preference stack. And basically there's sort of a mismatch between expensive venture capital and often sort of the economics that you expect to see from kind of funding steel in the ground. So, for companies that can't raise billion-dollar venture rounds, sort of a question of sort of what are your options? And ultimately, as we think about kind of what is needed to bring climate solutions to scale, Really sort of the billion-dollar scale is, I think, what is needed both for sort of successful financial outcomes for many companies, but also to see sort of the scale of impact that we need to address climate change. Really, venture capital is a very small portion of the overall climate capital stack. So this is a chart showing sort of dry powder over time, and the bulk of the capital that's sort of available in this space is infrastructure. The question is sort of how do you get there? So we like to talk about the transition from kind of venture to infrastructure. It's partially a question of technology progression, but I think it's also just as much a question about the transformation of culture and people at firms. So I think venture VC investors are often looking for kind of companies that move fast and break things. Infra investors, on the other hand, want to see companies go slow and sort of measure everything twice, because it's not a question of will it work, but can you build this on schedule, on budget, with contracts that de-risk the project and sort of operations that kind of fit within the modeled parameter. The pro forma actually needs to translate to reality to justify sort of the lower cost of capital that infrastructure investors bring to bear. And so while VCs race to be first, infrastructure investors race to be first to be 10th. And so that is a challenge. So our firm, we kind of think about ourselves as sort of stepping stone infrastructure capital. And we often, our kind of mantra around the firm is how do we develop the developer? Most of our team comes from project development and EPC backgrounds. And so where helpful, look to really work side by side along the companies that we partner with to help de-risk execution and bring companies further down that sort of cost of capital curve. So we invest in companies with proven technologies in sort of these emerging asset classes. And every single one of our investments is really two investments in one. We offer both growth capital, sort of growth equity, as well as project capital, typically kind of $20 to $50 million per company we partner with. And some example portfolio companies invested in EV charging, in geothermal, in green data centers, and in sort of building material manufacturing. So the point of this presentation is the reverse pitch, and I wanted to talk about what we see as sort of an emerging opportunity around kind of a new infrastructure asset class around autonomous vehicles. So I think, for folks like myself who live on the East Coast, I think autonomous vehicles have always felt like they're 5 to 10 years away. I think those who are coming from San Francisco, maybe the reality feels like it's here. And I think it is actually, I was surprised to learn that in San Francisco, the ridership of Waymos has now surpassed Lyft. So if you live in one of the few cities that have autonomous vehicles, they are here. And I think it's around 15 to 20 cities in the world today that have commercially available autonomous vehicles. But there's a long tail, about over 100 cities that are currently piloting autonomous vehicles. And so over the coming years, whether you like it or not, you're going to be seeing vehicles driving around on the streets without people. And that creates a whole lot of questions about how sort of systems will need to evolve around them. But from an investor perspective, this is a massive opportunity, looking at around $1 trillion market by 2035. I think just in sort of robo-taxis alone, about $500 billion, and autonomous trucking, another $500 billion, sort of on the come here soon. And really, this transformation of our transportation systems is going to be driven by kind of cost, safety, and convenience. So I think the biggest advocates for autonomous vehicles talk about the safety aspect. Sort of, I think it's like 50,000 deaths a year in the United States that come from human-caused accidents. The data so far from Waymo, they've had over 150 miles logged. They've 90% fewer accidents. There's also, I think, a cost element, and this gets into, I think, some social questions because, not paying someone is cheaper than paying someone. And so long term, we're I think, seeing that robo-taxis are going to be twice as cost effective as sort of human powered vehicles. And then lastly, I think there's a convenience element. So if you're someone who commutes to work, I think on average in the US, people spend 50 minutes a day commuting. And so if you're able to not be driving, you can be doing other things with that time. So as we think about this sort of next stage of our transportation systems, in just the last 150 years, we've gone from horse-driven transportation to needing to build out whole sets of infrastructure around internal combustion vehicles. Now we're building out infrastructure around electric vehicles. And soon we're going to be building on infrastructure around vehicles that are driving themselves, and I think that does raise some new questions. So I think from the infrastructure perspective, we see a couple different models, and there's definitely more. One is actually the business model of owning these vehicles. So while groups like Uber or Waymo may have the underlying AV technology, these companies do not want to be in the business of owning and operating vehicles. And so there's a whole business model around the kind of operations of these fleets of autonomous vehicles, whether they're robo-taxis or trucks or drones or other things. Second, there's the whole servicing of these vehicles. And so, unlike an electric vehicle today where you have someone going and plugging it in and maybe cleaning it on their own, I think we're going to be seeing depots around autonomous vehicles, not just for the charging, but for the cleaning and for the maintenance and repairs to service these vehicles. And then lastly, there's definitely a significant energy component of this as well. Just like electric, I think the expectation is almost all of autonomous vehicles will be electric. And so I think there are business models that are going to be needed for behind the meter optimization through on-site generation, batteries. And then also, I think, the sort of vehicle to grid model that people have been interested in, I think will really come to bear with autonomous vehicles where you effectively have fleets of batteries that are driving around, and there's ways to get more sort of economic value and use them as an energy asset. So as we think about sort of an investment perspective from an infrastructure lens into these autonomous vehicles, really just looking here at kind of autonomous vehicle depots, I think this is a business model that's largely going to be really centered around real estate. So these centers will need to be centered, located in kind of attractive locations to minimize what people talk about as deadhead miles. Really, the economics of AVs is going to be all about utilization of the vehicle. These depots are going to need to have significant power capabilities, so 5-10 megawatts. The equipment will need to be reliable, fast charging. There's going to need to be maintenance and cleaning services. There's going to need to be robust Wi-Fi and data connectivity, so it can't just be in kind of like an underground garage. If these vehicles can't connect to data, then they're not going to be able to work. And then I think also there's sort of going to be an interesting dynamic of depots versus pit stops, where maybe AVs will be charging up on the highway and then sort of getting serviced at depots. I think Waymo services their vehicles like every 200 miles, so it's actually fairly significant. And then from the infrastructure lens, I think similar principles of needing to see contracts, offtake agreements that sort of de-risk the revenues of not just building it and they will come, and then sort of all of these other kind of aspects that folks look to see. And the last thing I'd say is, even if you're a software company or entrepreneur, I think it's still important to understand the infrastructure and project development lens. We've seen so many companies that have gone out with this cool new EV charging software, sort of can't wait to deploy it, and they find they're sort of stuck with the same bottlenecks that affect kind of the hardware side of the world. So thank you all, and looking forward to the conversation.
Thanks, Noah. So Noah, can you talk a little bit more about the missing middle problem and how you guys, as a firm, approach that in working with, developing the developer? How do you guys look at investing in maybe the top co and then the projects, and then maybe more on this autonomous side, like as an example, if you had a developer that was doing this, right, and ultimately you're looking to sort of finance these depots, et cetera. What is the end game? What's the investment thesis there? How does it look for sort of you as a project finance investor and your earlier venture investors in developing this type of model?
Yep. So in terms of how we work investing in the missing middle, we invest both in sort of the corporate, VC rounds of a company as well as in the projects. And we find this model sort of helps to both de-risk and add value on both sides. It's, I think, helpful to have sort of a project finance person, that voice at the board level, but also in sort of these early stage companies. I think while infrastructure investors, sort of more kind of mainstream ones, can be quite zero sum about the success of the project. For earlier stage kind of on the come asset classes, I think when we see projects be successful, that also creates value for the overall platforms. And so we really look to be, I think a lot of the companies we work with have, like any early stage company, many of the elements there, but not all of them. We've been running a 2-day seminar for the last couple of years called Developer U, where we invite our portfolio companies as well as other companies that are interested in a 2-day seminar on like everything around project development, project finance. For those at Yale who've taken like REPF, that's like a component of it, but then also how do you think about EPC, contracting, engaging with lawyers, things like that. And in terms of like, where we see sort of investment outcomes as it relates to, let's say, autonomous vehicle charging or others, most of our portfolio companies end up being, I think, attractive targets for infrastructure investors. So I'd say, many of the exits from our portfolio have been sort of larger scale infra investors who now see you've built out this portfolio of spinning assets that has now kind of a proven track record around cash flows and a great opportunity to sort of sink, $400, $500 million into to build out that next sort of pipeline. So that I think is generally success for us, and I think can still be quite a successful outcome for kind of venture investors investing alongside us.
Thanks, Noah.
All right, how's that? Okay, cool. Hi, everyone. I'm Adriana. I'm a principal at Salesforce Ventures and also an SOM alum. When you were just talking about AVs, I live in SF and I tried to call a Waymo this morning. And I was like, oh yeah, San Francisco's a bubble. But anyways, it's really nice to be back here. I haven't been back in a while, so. We've heard some pretty interesting pitches, power, AVs, and I thought we said I should go last because I'm going to probably talk about the most out there conversation today. And I want to talk about problems that we might need to leave Earth to solve. So quick context on Salesforce Ventures before we get into it. We are a global CVC. We're one of the largest in the world. We've invested over $6 billion, but we really operate as a financial first VC. We exclusively invest in enterprise tech. But we are very broad beyond that. We invest Series A to IPO, and we're always looking for companies that are building the critical infrastructure for the enterprise. We have a very large portfolio, as I mentioned, over 400 companies. We were early in Anthropic and Databricks and Stripe, and then we also kind of invested in the prior generation of the enterprise, so Snowflake and Twilio. I lead a lot of our climate and energy investing, which is why I'm here today. Saw some of the names actually in Eric's presentation. So Base, and actually one of our portfolio companies is here, which was a nice surprise. And Peter just spoke before me at Altana. So that's what I spend all my days doing. And about a year and a half ago or so, I noticed that a lot of my co-investors were starting to make space investments. And I thought that was very curious, and I didn't really understand why. So started looking into it a bit, and that kind of ballooned into this many months long research project. And since then, my team and I have spoken to well over 100 people, including founders and investors, scientists, engineers, about what is happening in space right now. Is this a real market? And actually, we walked away very bullish. So I'm going to walk you through what we learned. So this slide kind of sums up our basic thesis. If you think about it quite simplistically, building trust really is getting much more difficult and expensive. At the same time that building in space is getting cheaper and easier. So construction costs have risen almost 1,000% at the same time that launch costs have come down almost 100%. So you have this gigantic asymmetry since the 80s. And ultimately, this basically means that the economics of where to build are really being rewritten in this moment. And if you used to ask, why would you build in space? That's a wild thing to do. We can actually start asking, why wouldn't you? So why now? 3 things are really happening simultaneously. The first I just mentioned, its launch costs are coming down, but it's not just that. It's also that launch frequency is going up. This has a lot to do with how the rockets are being built these days. And these 2 things just mean that access to space has increased a lot. The second is the demand side pull. It's actually similar to what Eric was talking about on energy. Everyone knows about the demand crunch right now. Data center vacancy rates are at a record low. And what you're seeing is all these tech companies are starting to look for alternatives. And almost all big tech right now is actually investing a ton in space. A lot of the logos you see here, but I'll actually call out Anthropic, which just in the last month announced a $45 billion deal, I believe, with SpaceX. They're going to spend $1 billion a month in orbital compute, and that's before we've even actually seen data centers in space yet. So it just shows you the demand is so strong right now. And the last is on the market. You know, space used to be kind of the purview of governments. That's really shifted over the last many years. So today, actually, over 75% of the space economy is commercial. But at the same time, governments are also ramping up. So you have these two tailwinds behind you. And that basically means that the market is expected to triple over the next decade. And we're looking at reaching about $2 trillion by 2035. And then the last thing, obviously, we have to talk about, it's very relevant right now, it's coming up in the next few weeks, is the SpaceX IPO. TBD on how this plays out, we'll see. But if it goes to plan, this will be the largest IPO in history, potentially 3xing the previous record, which ironically was Saudi Aramco. Kind of a controversial one, of course, but like, let's ignore the companies that Elon has bolted on to SpaceX for a second, like X and XAI. Let's just focus on the space piece of the business. It's actually really healthy. So Starlink and launch last year combined for over $15 billion in revenue. Starlink is profitable, launch is about to be. And so you just have an example of an incredibly powerful space behemoth with really strong economics. And this is really changing the market. So institutional coverage is opening up. Almost every bank is assigning teams to space. We're about to see the cost curve thesis validated publicly, and of course, a clear exit path. But I actually think the most interesting part of the SpaceX IPO is what's happening on the venture side. A lot of the big VCs have a ton of capital wrapped up in SpaceX. And the thinking is once it is recycled to those funds, they are going to redeploy it in the new generation of space companies. So you're going to have this kind of entirely new seeded market of space companies. All right, so before we get to kind of the fun part on companies, just want to make sure we are speaking the same language on the infrastructure. There are multiple orbits, and each have their own unique economy from LEO to GEO. Just a note on the scale here. This is definitely not to scale. If I wanted to show you lunar for real, I would have to have kind of 10 screens out the door that way, but at least it gives you a sense. LEO's where most of the commercial market is today. It obviously is the lowest latency. As you go further away, latency increases. GEO is kind of the legacy telecom layer, but actually a lot of kind of newer, emerging, interesting things starting to happen there. And then the really deep tech stuff, all the way on lunar, where truly lunar mining is starting to be talked about or innovated. But that's kind of a 10-year plus horizon. So I really think about the conversation today between LEO, MEO, and GEO. And the value chain is very complex, much more so than a lot of people realize. It's not just rockets and satellites. Every single node that you see here is an investable category. So that means ground software and in-orbit servicing. There's quite literally an economy within an economy in space that's emerging. So when we sat down to kind of map this entire space, it was actually very daunting. We didn't appreciate the scale. We talked to an early stage space investor who had spoken to 9,000 space companies. But we tried to narrow it down to just those that are venture-backed. And that's about 1,000 or so, and they've raised over $70 billion. But when we think about how do we actually approach this map, we think about it this way. So we think there are 3 categories of companies that are most likely to create durable VC-backed outcomes. So the number one is vertically integrated companies. This is true in Power 2. We're actually we're investors in Crusoe, if you know them. They're an AI factory company. And their whole approach to data centers is to be vertically integrated, and that's worked very well for them. We think there are parallels in space, where if you can own multiple pieces of that stack, maybe not even launch, which is kind of SpaceX's game, you can still have a lot of defensibility around the supply chain. The second is companies with a technical breakthrough. Really here, that just means that they have IP as a moat, and that's obviously more defensible. And then the last, which is probably more kind of unique to space, it's companies where they can command a really large margin on top of launch costs. So in other words, that means that the value you're capturing in orbit far exceeds the cost of getting there, so it just makes it worth it to pay for launch. So what does that kind of mean in the context of climate and energy? I would argue that space is really becoming critical climate infrastructure. This is true across many use cases. As I mentioned, they're kind of emerging at any moment, but I'll just mention 3. So the first is climate intelligence. Global EO, that's Earth observation, is really becoming the ground truth layer for many things, including wildfire detection, methane emissions, and risk modeling. This is probably the most advanced market. This has been true for a long time, but there's still a ton of innovation happening as we send satellites up to space. The second is pretty exciting. It's space-based energy. This is becoming more real, and we're getting closer. Obviously, orbital solar arrays collect 24/7, so you don't have to worry about land use or night cycles, of course. So we're definitely not there yet. There's tech risk, but it is on its way. And then the last, I'm sure this is going to be the sector you hear about the most going forward, is orbital compute. With data center demand, this is just truly kind of through the roof. Ultimately, I mean, if you're going to build a new generation of AI infrastructure, doing it where the sun shines all the time and where you don't have all of the carbon issues, space is potentially a really good place to do it. So there are certainly some economic considerations here. There's a lot of debate on, when this will happen, when this will be profitable and the unit economics will work, but I certainly think it's going to be in the coming years, call it 2 to 7, and we're pretty close. So that's kind of how we think about this. I can't yet say who we're investing in, but stay tuned, and I'm happy to take questions.
That was awesome. Thanks, Adriana. I noticed that your cost curve was logarithmic, so I thought that was pretty interesting.
Can you guys hear me? Yeah. No, thanks.
So I was wondering if you could chat a little bit about your own investment thesis, if there's a sweet spot for you guys as SAP. In terms of
For space or generally?
For space, generally. Yeah. And if it does overlap with sort of a climate theme, that'd be even more interesting. But within this sort of framework, is there a sweet spot? And then how are you looking to sort of partner with some of these companies?
So I think the trick answer is actually that companies that can be in multiple categories. Obviously, if you're building a space company and you make it work, probably going to be defensible for a while because it's tough. This is not software that you can kind of just ship and beat someone. You're building literal rockets or literal satellites. But, as we've talked to companies, we've met many software only, some that are kind of in each of these categories. The ones that we do find the most interesting are kind of bridging multiple moats. So, for example, they take Muon, they're at the top there. So Muon is a satellite company, but really what they say is they are a mission foundry company, which means they're basically a full stack space company besides launch. We'll get into this later, but launch is really the toughest thing to do. That's why SpaceX has kind of a monopoly in the market right now. So you're very unlikely to find companies. There are launch companies alone, but you're very unlikely to find fully integrated companies without launch or with launch. But Muon is basically, they say it this way. Like if you're a customer, you go into an auto mechanic shop and then they sell you an engine. And you're like, well, great, now I have an engine. And then I'm not a mechanic and I can't drive a car, so I need a car. Muon is selling the car. So they build the satellites, they sell the satellites, they launch the satellites, and then they operate the satellites from space. And it's really truly space as a service. they're a super interesting one, and I think they are both vertically integrated, but because they operate the satellites from space, they have that software margin on top of the launch. So they're really 1 and 3. And I think those are the ones where we're getting most excited.
Very cool. Thanks so much.
Sure.
So we got you guys come back up. Now you guys get to ask questions, but I'm going to ask sort of, I don't know, semi-boring tee up for you guys, which is really focusing more on the reverse pitch piece and how you guys as investors work with founders, work with entrepreneurs to build a relationship. Because, as I mentioned in sort of my opening, venture is very much project finance is very much a relationship game, and it's a long-term one. And so, how do you guys approach meeting, engaging with founders, with teams? How do you and your firm look to sort of nurture that relationship, both from initial investment through the life cycle of that investment, and help them succeed? Do you look to lead? Do you look to co-lead? Do you take board seats? Sort of just let's lay the groundwork for folks so they get a little bit more input into how you guys think about that. So, Adrienne, you want to start?
Sure. So, I think CVC, which is corporate venture capital, can sometimes get a bad rep, though I do actually think that's changing. But that's often because CVCs can be thought of as slow or kind of intractable, and I think that is true. But I also think that when you do CVC right, which is tough to do, but if you can, you actually have a really amazing strategic edge and is particularly helpful for founders. So it means that you give them both capital, but also true value. And in our case, that's why we exclusively invest in enterprise tech. It's because Salesforce's secret sauce is selling to the enterprise. It's like the best go-to-market machine you can have. And so when we're talking to companies, our value add is on enterprise customer introductions, enterprise motion. How do you kind of start and keep that flywheel going? So we invest Series A to IPO. We specifically start at A and don't do 0 to 1 because that's when the enterprise motion really begins. It's pretty unusual for seed-stage companies to have quite serious enterprise contracts. So we come in when that is just starting or when it's really established and we can help them really scale. And I think for founders, to your question on how do we build relationships, at the end of the day, every founder wants customer introductions. It's the number one thing they want, usually. And that is where we spend almost all our time building relationships. And, especially as any VC will know, the best deals are the hardest to get into. And your value doesn't start once you invest. Your value starts, you have to show value years potentially in advance just to be able to get access to that company and that founder. And so, we spend truly years sometimes building relationships, and that means meeting with the founder, doing customer intros well before we've ever put a dollar in, bringing them to things, we've sent out SWAT teams to their companies to work on their go-to-market. So it is definitely a long game, and sometimes that doesn't pay off. Sometimes, you do all that work and you don't get into the round, or the round doesn't come together, whatever it is. But that's the game that you have to play.
Just a quick follow-up. So does SAP Ventures have sort of a target ownership? And do you guys sort of try to phase that in, or how does that all work?
We have such a big fund and a big range that it varies. Obviously what you're investing in a Series A is very different than what you're investing in a pre-IPO round, but we think about it less as specific ownership targets versus check sizes relative to the round. So at a small kind of end of the scale, we're investing around 5 million, but we can also invest up to hundreds of millions. But what we're really trying to do, because we have such a wide range in our stages, is really double down on our winners. And I really think that is the strategy for successful venture, is to get in, but then make sure that you are reserving a ton of capital for the ones that are growing and just keep investing.
That's awesome.
Sure. I think like Adriana said, for us it's a long game, both
after the investment, but also before. And I think our most recent investment, a company called Zanskar, they're kind of a next generation geothermal developer. We started building relationships with them, I think 2 or 3 years before we invested. They came to one of our Developer U events. I think we saw as in their earlier rounds, as they were sort of looking at a first project, they didn't quite yet have the sort of project development, operations, construction management team. They ended up hiring a lot of that team from Hormat, one of the established companies in the space, and that for us was sort of the trigger to get more excited. And we ended up leading their last round and setting up an asset financing facility with them. I think for us, we invest in venture rounds, so we tend to lead. We're often sort of the investor for a company that has the most capital sort of in by the time they're kind of funding 1 or 2 projects. But I think for us, a lot of the interaction happens sort of probably true for everyone here, but definitely happens outside of the board meeting. So, project development is very dirty work, and there's like a lot of day-to-day decision making on, you're trading off risk and returns and thinking about, we tend to be involved in sort of all of the contract negotiations and things like that. So we tend to have kind of relationships both at executive level and then often sort of a layer below as well. We have a portfolio operations team that sort of comes from the EPC space, and they tend to be quite involved. So I think that has sort of become our value add. I think it's been helpful for us to be sort of invited into deals where other venture investors in a portfolio company may see a need for having an investor alongside them who sort of does the project finance, project development thing. I don't know if I answered the question there.
I was going to start with it starts before, but they've already covered that. But it does start before. It could start years before. Even when you're investing as a first check-in to a company, a lot of companies aren't ready to really take money in yet at those stages. Like they're just too early, even for us. And so there needs to be more development. So there might be introductions at those stages to fellowship programs, to educate on grant programs that they might be able to apply to. But really it's just maybe there's customer kind of introductions as well, because you can get customers before you raise capital also. So it could be any of the above as just ways to continue to engage with companies that you become friendly with, because it is a relationship thing and those relationships develop. And sometimes if you don't invest even in that round that's coming together right then, you might invest in the next round. So knowing folks and being helpful to folks is a good way to just garner those relationships. But after investment, it's also introductions before investing, I guess, to co-investors, after investment to investors who can participate in future rounds. So starting to let people know that, hey, this company is in stealth or up and coming. Y'all should take a look, because a year from now they'll be raising again and they're right up your alley. Like those kind of introductions are very, very helpful. The warm introductions are super helpful to the founders. Same thing with customer introductions. But also like on the day-to-day business stuff, advising and actually answering questions that even if you're not a board member, companies sometimes are more likely to come to you for advice because they need advice to deal with the board even. Or they need advice on that they're not comfortable going to the board for yet, and they're trying to develop a thesis, or they're really trying to go after a particular thing. Maybe they're negotiating a contract with a customer, and they know that you're someone who has negotiated those kind of contracts before, and so you can actually help them on how to structure the deal or things like this. So, there's a lot of ways you can be helpful throughout the journey.
That's great. I can't get my mics to work. So I had a space question too. So I'm going to move over to sort of some of this industry stuff now. When you showed that graphic of, needing whatever it is, 10 panels, right, to sort of accurately depict the sort of vastness of space. And my question is very much like sort of a physical question, but also one of policy, which is how do you see it sort of developing in terms of international policy and control? Who gets to put what where, when? Who has to take what down? How is it sort of networked? So curious as to as this is sort of a burgeoning
marketplace, both physically and economically. How is that being managed, and how does that influence sort of your decision making?
Yeah, it's definitely a question we asked, and it's fascinating. We were actually talking about this at dinner last night. The short answer is that right now, basically, it's the Wild West up there. Obviously, no one regulates space. Not one country regulates space. There is a very old kind of international agreement that semi-regulates, but not really. Each country, of course, has their own regulations. Like in the U.S., the FAA is obviously who you have to apply for satellite launches. But I think the answer right now is that, yeah, we don't know. And obviously, there's the really interesting things happening in commercial space that I talked about. But there's also the very scary things happening in space, or could potentially happen in space soon, with national security. And that's really when you start asking policy questions. I mean, that is very real that there could be a space war or war from space. But I'm not making this up. And so those are the questions, when you talk about policy, it's not just who can get up there, but what happens when you are. So I think, that's just put on all your radars. But I think the other question about kind of how much can we put up there before things start breaking? From a physics perspective, there isn't really a limit in theory on how many satellites you can launch. Of course, at some point, are they going to start running into each other? What about debris? So there are different countries have decommissioning regulations. Like in the U.S., it's 5 years, though some have obviously stayed up there for much longer. But I think the honest answer is that this is an unregulated market.
Yeah, that's pretty wild. I remember, I think it was early '80s, the Reagan Star Wars animations, and sort of laser beams coming out.
So
It took 20, 40, 50 years to get here. But I think that's wild. And anyway, thanks for answering that.
So now, I know we have about 15 minutes left. I wanted to open it up, but I know everybody's got a ton of questions. So I'm going to start with Brian.
Okay. Thank you. Constantine, thank you for asking a space question. I was a little hesitant. So a lot of business to be done, and we're needed? Okay, first time for everything. A lot of business to be, a lot of opportunities up there. At the beginning, you sort of understandably deferred the getting there issue to SpaceX. Getting there is a big part of it, and we're a long, long way from being able to Waymo to our favorite hotel in geostation.
There's a YC company building space hotels. Of course there is.
In the meantime, are you seeing other technology, and we're at the climate track of the summit, and every launch is beautiful and might just pollute a little bit. Are you seeing other technologies starting to emerge? And somebody said the word laser, so I'll just bring it up. But are you seeing other technologies that might look interesting, or other companies in terms of getting off the planet? Thanks.
Yeah, it's probably the single most important question when you're actually thinking about investing in this space, because you have to confront SpaceX. It is, honestly, credit to them. They have built this kind of unbelievable company. It took them a very long time to do, but they have really monopolistic power right now. So I think you have to think about it in two ways. One is, how do you deal with SpaceX now, and then what comes next after that? So today, the companies that have close relationships with SpaceX for launch or for anything else, and are pre-buying launch slots, those are also the ones that we're excited by, because that in and of itself is a moat, because there is only so many of them. So I don't care what you want to build. If you can't get it up there, it doesn't matter. So that's kind of in the nearer term. In the longer term, there are certainly companies that are trying to compete with SpaceX. There's obviously Blue Origin is the most well-known, but Rocket Labs, Stoke Space, Stoke is a VC-backed launch company. There's also companies like Cowboy Space that they're trying to do orbital compute, and they're trying to basically hack launch by doing it much more cheaply. Instead of sending up Starship, can we just send up a really cheap rocket that can just get the compute up there, and then who cares if it blows up in space? We don't really care about reusability. So I think there's a lot of innovation, but I think realistically, timeline-wise, you have to, for right now, think about SpaceX as your vehicle and then hope that in like 5 to 10 years, you're starting to see more competition come in.
Go ahead, Jeff.
Thanks. Thank you for your insights here. My question is on the sharp shift in government funding priorities in the climate space. Climate is now a four-letter word at the Department of Energy, and other major funding sources for some of your investees and partners that might rely on some of those kinds of funds for non-dilutive capital. But beyond just the funding issue, you have a long-term effect of reduced number of PhD and graduate students with certain skill sets that might ultimately filter into the companies that you're investing in and supporting, or those who might get started. What are your short and long-term risks that you're seeing with government prioritization changes in the climate tech space, and how are you advising your investees and partners to address what we hope is a hiccup but could be a longer-term impact?
Well, climate tech is tech. So why do you have to put the climate word on it in order to propel yourself forward? And that's, I think, the learning, let's say, from the last couple of years. And when you're talking about space, for instance, like, and thus, my narrative around new industrial revolution, it's the learning is that these companies are going to be in space too. I mean, you have companies that can turn carbon dioxide into fuels. How are you going to fuel things when you're in space if you're not able to produce fuels because you can't drill? There's no dinosaurs on the moon, so you can't get oil up there. So what are you going to do, right? So you need to be able to produce it from other things that are there, and what's going to be there is carbon dioxide, and there's going to be agricultural waste or whatever food waste there is. There's going to be other waste products that you can turn into plastics, that you can turn into chemicals, that you can turn into fuels. So you could call it climate tech, or you could call it space tech. You can call it whatever tech you want to fill that void into what's needed. If you look at a lot of things that are being funded, it's nuclear. Is that climate tech or not? I mean, I think you'd argue it's climate tech. Critical minerals. A lot of the critical minerals technologies are taking waste product, then they're extracting value from it. It's our recent investment together is one of these. So that can either be looked at as like you're taking waste and turning it into value, or it's critically important to national security to be able to produce metals locally.
So it's a branding play, basically, is what you're saying. But what about
Kind of like everything.
what about workforce?
You're talking about talent, PhDs, masters coming out of universities.
PhD matriculation across the country this year has dropped notably due to losses in federal funding, public and private school financing challenges, higher education challenges. Like in my department alone, we've seen a 60% drop in PhD matriculation. And I see that in many departments. I'm talking about that, and I see that across schools of engineering across the country. What about that risk?
So Jeff, just to clarify, is that due to the university not having the funds, the labs not gaining access to the funds to then support those students? Or is that just sort of a dual part problem where students are afraid that they're going to get into a program that may be at risk? Or
It's immigration barriers to bringing students in from countries. It is institutional financial mismanagement at the universities themselves that are lacking support, and the federal government is actively trying not to fund people. So this is a three-pronged attack on graduate education in the United States, which will devastate workforce development at higher education for particularly engineering type challenges. What is that? Are you guys seeing that? I mean, you're not going to see that. There's a 5-year lag time, right?
There's a lag.
But then it stays with you for 5 years, even if you would fix it today. And so that's kind of a long-term risk. I mean, are you seeing this in your companies that you're working with?
I mean, not yet, but I mean, where we're seeing it is grants are harder to get and things like this, but it's not, the workforce thing isn't a thing that we've seen yet. I mean, AI also has been a force multiplier. So you kind of have the risk that gets talked about more is how's AI going to disrupt industry, and how you're going to need fewer people. All the junior people aren't going to be there. So it's the same kind of thing. How are you going to get an educated worker if junior people aren't needed and they can't get trained because there's a gap in what the world needs? But I'll let y'all opine on any of the rest of it. That's a tough question. Probably whiplash later too with the political environment changing the other way. So.
Yeah, I mean, I wouldn't sugarcoat it.
I mean, I do think the climate tech space has historically benefited from kind of a halo effect of like, there's probably been more talent going into the sector sometimes than there are companies that are, can make use of them. But I do think long term, clearly this is an issue from our vantage point in the sort of infrastructure world. I think the labor challenge is more on like the trade side, which will be interesting to see as sort of AI takes away jobs. This seems like a space that young people should be going into, but we need more electricians and plumbers to go build out all of this infrastructure. And then, I think lastly, on the point on policy risk, I mean, the clean energy industry has seen kind of like whipsawing, even going back to early days of like Bush to Obama, where these tax credits exist and then they don't. I think the correct answer that investors always want to hear is like we're not relying on policy, these subsidies. But that's not. If you look at the industry overall, it's not true. A lot of these, most of these projects have gotten built with federal funds, state funds. And so I think where we're seeing companies be most successful, it's really in that ability to adapt, because one moment you think you're building a project here and you're going to get this tax credit, and the next you maybe have to pivot pretty significantly. And not every company is able to do that, but the ones that I think are able to, there's clearly a lot of new tailwinds coming in with data centers, more enthusiasm around geothermal, nuclear. And so, I mean, this is why we're seeing like Allbirds now rebranding as like an AI company. Clearly there are new forces that companies can try to latch on to.
Any thoughts?
I'll just say that my other idea for my pitch today was on labor, because I do think it is honestly terrifying what's about to happen. Or terrifying, exciting, I don't know, cuts both ways. But yeah, the labor disruption that we're facing at the university level and knowledge work, I think we are truly just on the precipice. Like I mentioned, we're in Anthropic and we have been for years and years, but even as someone who kind of like lives like this in Silicon Valley every day, I don't think it really hit me until this year, kind of truly what's about to come. And I think we're kind of sitting on the edge.
And my input, and I'll give the next question to Matt, is maybe on the early stage side, very early stage proof of concept side of the spectrum, we're going to start to see that where there is sort of fewer innovation coming out of universities, but within sort of the bulk of it, we're investing in companies that are 3, 4, 5, sometimes 10 years old. And like I mentioned earlier, a lot of climate tech is infrastructure based. There's a lot of physical sort of engineering, hard tech that goes into it. And these companies have been around a long time trying to sort of prove their tech to the market, with a lot of help from the federal government in the past. And then they kind of go through this cycle of like rebirth, where like, they'll get a partnership, they'll finally get an unlock, they'll find the right product market fit. That's just the nature of the beast in a lot of climate tech. So I don't think we'll really see that impact for, like you said, 5, 10 years in a good part of the market. So, Matt?
Yeah, great panel, thank you. Adrian, you mentioned that you reserve massive capital for follow-ons, which is, I feel like so many funds now are only doing 1, maybe 2 rounds, and that's it for the fund. So curious to hear from Noah and Eric your strategies and also sort of what is happening, and if you think climate's different than other sectors, just sort of any thoughts y'all have venture funds and appropriate reserve strategies.
So we tend to reserve quite a lot of capital for each of our portfolio companies, just because we expect our portfolio companies to deploy multiple projects, and we want to fund those projects. And so, because we're investing all out of the same flagship, we may be reserving $50-60 million for a company to fund projects over a couple of years. Inevitably, some of that funds also sometimes gets allocated to corporate rounds, and I think right now in the market, it's been a little bit like feast and famine. If you're an AI data center related company, you're able to go raise capital at high valuations. If you're doing something else, I think there's been a lot of sort of hunkering down. We've seen a lot of bridge rounds, and so we kind of experienced both ends of that in our portfolio. I do think as we have evolved, we've started doing more like seeding of our own platforms, taking more kind of majority control. I think we'll probably continue to do both co-investment with other venture VCs, as well as sort of committing kind of more to that long-term relationship of, you know, we want to grow with you for the next couple of years to really prove the model out.
Yeah, we don't have the luxury of having a lot of capital to be able to reserve a lot of capital, I guess is our, model for the moment. If you have a lot of capital you can give us in order to change that, I will hold a lot of reserves. But on the like true end of it, like the thesis was diversification, and for our fund one at least, it was diversification across industries, across sectors, across technology types. So it was smaller checks in, recognizing that we weren't going to be the deep pockets later, but recognizing that we were going to be holding reserve for follow-on. Some companies would get follow-on, others weren't. But it was really targeting companies where we thought there were like 100x outcomes that would be coming out of our first check-in, and then the later checks would be like a 10x outcome, a 5x outcome. So if you're getting in that early and you have that mindset of that's what the outcomes are going to be, you need to find other people that have those kind of pockets to come in, and we've developed those kind of relationships and have had success with whether it's corporates. Like being in Houston is beneficial because a lot of the companies customers are going to be in Houston, and also the co-investors at typically later stages than we're investing are going to be in Houston. So we've had a lot of success introducing into the Shell, Chevron, Aramco, BPs, for instance, but also to later stage investors that can kind of keep things going from there. We haven't had success yet with Spring Lane though, so we're hoping to get that one day as well.
You've had some success with the SPV model as well, right? So it's
we followed on both out of our fund, but also we raise special purpose vehicles, which are co-investment vehicles that go into single name companies. So we'll raise those typically alongside a round that we're investing in, typically in a company after we've made an initial investment. So we've gotten to know the company, it's de-risked. We can pitch a story to our LPs, to our investors, to other investors that we know to come into those vehicles. And even recently we've raised, we will have raised I think 3 of those in the past 2 months, which is not normal to be in that kind of situation where we will have done that because we went through like a year where we didn't do that too. But that's the companies have matured, and now you can point to success, and that success becomes a story where people want to invest. Whereas it's hard when you're like, oh yeah, well, it's the first money into the company, and we like, here's the story, it's really exciting, but then it's like they haven't achieved enough yet. They don't have that pilot plant up and running, or they don't have that demonstration plant up and running. Once those things are happening, they're easier stories to tell to investors, at least that want to come into those vehicles. But it's a lot of the follow-on has been bigger out of the SPVs than have been out of the fund.
we have time for one more question. Anybody? Sorry. You think you're hand up first?
It's all good if you want to answer.
Given the current state of geopolitics and how many disruptions have been happening to global logistics chains, have you been looking at or examining how to reduce those logistics chains, make them more independent of these giant global systems? I mean, I'm specifically thinking about things like power requirements, right? With the Strait of Hormuz being blockaded, oil prices are going up and up and up. Have you been examining any kind of answers to those questions?
Yeah, I mean, the new industrial revolution is the answer to that question. You need, localized production. You need to disrupt the supply chains, basically. Like, don't be a part of that supply chain. Create your own supply chain locally. So if you can take, local manufactured or offtake of, Fast Metals is in the room today, so I'll bring them up. They take a waste product from aluminum processing, and they can extract